Hi everyone, welcome back to another video. So today I have an extremely special guest. So I have the legendary Adam Khoo here together with me. So I believe he's one of the pioneers in the entire finance YouTube space, especially in the Singapore scene as well. He rivals a lot of all the bigger creators out there. So hey Adam, how have you been?
I'm good. I'm great. Yeah, great to be here.
So maybe just a short introduction to my audience for those of you who are living under a rock and not know Adam Khoo.
So, I've been teaching finance since 2005. So it's been about 17 glorious years.
Right.
And before that, I was already doing my own business in many other areas as well.
Right.
So I started my first business at 15, and I did almost everything under the sun. I sold stationery.
Right.
I was a magician. I was an MC. I started a mobile disco company. I was in event management. And for the first part of my career, I did a lot of corporate training, training people in NLP, motivation, sales.
Right.
But my love has always been in investing. So I started investing actually at 17, but doing all the stupid things that most people do.
Right.
But I started investing in the Singapore and Malaysian markets back then.
Understand.
So I started investing in the US markets back in about 2002. So that was actually boom during the dot-com bust.
Right.
And so I managed to actually buy it near the bottom.
Right.
I was quite lucky because by the time when I got into the US markets, it was already down like 50%.
Right.
So I was in a university at the time.
Understand.
So that was really, ass luck timing.
Right.
So that's how I made a lot of money
Okay.
when the market went up.
Right.
So I thought I was really smart, but it's not because I was smart, I was just lucky.
Right.
So after that, then I began to learn a lot more about how to fine-tune my investment approach.
So since you started investing since 2002, to this time around it's 2022, so it's at least 20 years. So maybe just to understand in terms of your refinement and understanding your investment philosophy, like how do you position yourself, what's your strategy, and how do you approach the market in today's climate?
Yeah. Okay, so my investment philosophy is not climate dependent. So it doesn't matter if it's a bull market or bear market.
Right.
I follow the same strategy and philosophies. So essentially, when I first started, I didn't know the difference between investing and trading.
Right.
Like most people, right? They mix everything up.
Right.
You buy a stock thinking that it's a good investment, but you then end up trading it, or you trade an investment, and then everything gets messed up. So one of the things I did over the years to fine-tune is I really separate investing from trading. So there are certain stocks I say that they could be good for trading, but I'll never invest in them.
Right.
So I call them the slut stocks, right?
Right.
But there are certain people that you would date.
Okay.
You would have a good time with them, but you won't marry them.
Okay.
Because they could be exciting for a while, but they're not dependable, they're not responsible.
Right.
Okay. So I would say 80% of my portfolio is investing. So for investing, I only buy very safe and strong companies, fundamentally very strong companies. And I always say that in the whole market, probably only 1% of companies meet that investment criteria.
Right.
So that's 80%. And then 20% would be into more speculative trading. Stocks that could go up in the short term, but long run, I'm not sure. So for that, I'll trade it.
Okay.
And years ago, I would trade it using CFDs.
Okay.
Or trade the underlying stock. But nowadays, I trade purely with options.
Right.
Yeah.
Okay.
And then within my investing portfolio, I further divide it into about 70% capital gain, which is in my capital gain portfolios, and then 30% are the dividend portfolio.
Right.
So essentially that's the whole allocation.
Right.
Yeah.
So if you were to look at your entire portfolio, it's quite sophisticated. So there is probably a lot of maneuvering because you do options, you do trading on a few slut stocks in that way, and then you have a long only portfolio, right?
Yeah.
So how do you manage this entire portfolio position? And because I know that you do spend a lot of time studying the markets and stuff like that. So do you have any secrets or any tips for people out there that also wishes to do something like that?
Okay, so for the investing part, there is not really a lot of time required, seriously.
Right.
Okay. For investing, the time required is in the initial research.
Right.
Finding the company, making sure it's a great business, passing all the steps. Now that takes time. So that for a company, nowadays I can take probably about 2, 3, 4 hours to do in-depth analysis on the company.
Right.
But once I do that, that's it. There's not much time involved after that because once you know it's a good company, you put on your watch list and you just watch it for the right price. When it's significantly undervalued and you just buy.
Right.
And once you buy, just hold. Right? You hold through the ups and downs, and then I add regularly when it retraces to a support level. So the time comes in the initial phase, but once you buy, there's nothing to do. There's very little to do after that.
Right.
All right. So maybe I'll talk a bit about what's my criteria. Okay.
Sure.
So I think I mentioned this many times in my webinars, but right. So for investing, end of the day, I want to make sure that, remember when you buy a stock, you're not buying a lottery ticket. You're buying a piece of an underlying business.
Right.
So I always think of myself as I'm buying a business. It's a very Buffett approach. Yeah. So my first criteria I look for is that I want this business to be consistent, predictable, and resilient. Okay. So for that, I look at a track record of at least 5 to 10 years. So that's why I don't touch IPOs for that, right? So I want to make sure that at least the last 5 years, the company has consistently growing revenue, net income, and cash flow from operation. And if you just apply this criteria, it would eliminate 95% of the companies in the world. Right? Because less than 5% of companies are able to grow revenue, profits, and cash flow consistently. Because if you can do that, then it's predictable, it's consistent, it's resilient. Right? So that's number one. The second criteria is the most important criteria of all, okay, which is the company must have a sustainable competitive advantage, or we call it economic moat. Right? So essentially what that means is that I want to make sure that the company is able to protect itself against competition. It has got little or no competition, or the competitors are insignificant. Right? And the way a company has this moat is either through a brand monopoly, where the brand is so strong, you get this brand loyalty. So even if the competitors charge cheaper, better product, people won't leave because of the brand loyalty, like Apple, like Nike, brand monopoly, right? The second thing that gives a company a moat I look for would be the high switching costs. So once the customer uses the product, it's very sticky. It's very difficult for them to switch to a competitor, right? Then other things like high barriers to entry, network effect. So before I buy a company for investing, it must have at least 2 or more of these qualities. So I know that at least for the next 20 years, competitors cannot take away their market share easily. So because of that, they have pricing power. They can raise prices, they can maintain their margins, and hedge against inflation, right? So those are the 2 main things. I mean, there's a lot more, but 2 main things. Okay, throw in another 2 more. The third thing would be, I want to make sure the company has what we call low maintenance capex. So whatever money it makes, it doesn't have to keep spending a lot every year to maintain its operations. So I avoid companies in airlines industry. I avoid auto manufacturers. I avoid shipping. I avoid oil and gas. I avoid manufacturing. I avoid property developers. Okay? Because while they could do well in the short term, like oil and gas do very well this year, right? EVs do very well now because of the hype, right? But in the long run, will they do well? I'm not sure. Because these industries have very high capex. So whatever money they make, they have to keep plowing back into new factories, equipment, and that sucks up the cash flow. And these industries are also very competitive. I mean, so many oil and gas companies, so many auto companies, so many airlines, right? So when it's so competitive, margins are very thin, right? So these kind of companies have very low return on capital. So I totally avoid them, right? And of course, this year I look like an idiot, right? Because the companies that I buy are mainly in technology, consumer discretionary, healthcare, finance. And of course, this year they are down a lot. So I look like an idiot, right? This year. Whereas the industries that are doing well this year are like utilities. Like oil and gas, right? So if you bought that, you look like a genius, and I look like an idiot this year, right? And I'm fine with that because I know I'm playing the long game, and I'm not gonna switch to that just because in the short term it's doing well, right? Because I know in the long run the companies I buy will outperform, and yeah, so high return on capital, low capex, and the last one, well, actually there's more, but the next one is of course debt. So companies that have got conservative debt structures. All right. So once the company passes all those criteria, then I know it's a great business. And again, my guess is that less than 1% of companies are in that category. And then it's on my watch list, and I add shares consistently when it's undervalued. and when it retraces to support level. So I combine fundamentals with technical analysis as well.
Right.
So that's for the investing side.
Then in terms of your speculative part of the portfolio, where you try to ride momentums or stuff like that, how do you go about to do those kind of research?
Yeah. So for that, you can see, so for the investing side, it's very a buy and don't do anything thing.
Correct.
Right? Buy, hold, don't do anything. Right. The trading part is very, very active. All right. So decisions can change very, very fast. Like for example, 2 weeks ago, I went short.
Okay.
And before that I was long.
Right.
Then I went short. And then after 5 days, I covered my shorts, I went long again.
Right.
So in fact, what happened was, remember on Friday,
Yeah.
the market looked like it was going to bounce up.
So, correct.
Okay, because the labor report came in. Well, actually, the unemployment rate went up from 3.5 to 3.7%,
Right.
which the market looked at as good.
Yeah.
Because then the Fed doesn't have to be so aggressive, right?
Correct.
So the market looked like it was going to bounce up.
Right.
And also, if you look at the charts, the candlestick pattern looks like the market was going to take off, right? So I closed my shorts,
Right.
okay? And then I went long on my speculative positions using options, right?
Right.
And I did that at the start of the market session. Okay. Now I slept at about 3 a.m. that day. Okay. Singapore time, right?
Right.
Now what happened was midday the market reversed.
Right.
It went red.
Right.
Okay.
Right.
Because apparently Russia turned off the gas to Europe, and I said, "Oh shit!" Right? So what did I do? I went short again.
Right.
I went short again. Right.
Understand.
So in trading, you got to be really fast. You got to go long. You long today, short tomorrow, short back, long back again.
Right.
And I always say that in trading, a lot of people think that to be a good trader, you have to predict the market.
Right.
And that's what I thought when I started. But you know the reality is that no one can predict the market.
Right.
Because you can't predict what Putin's going to do. You can't predict what the labor report will be. So no one can predict the market.
Right.
So trading is all about following the market. If the market is bullish, you go long. Market is bearish, you go short. So you just ride the trends. Okay. All right? And at the end of the day, no matter how good you are, you can't be right all the time.
Right.
Because the trend can shift.
Right.
You go long, the trend shifts and you get stopped out.
Right.
So trading is all about money management.
Okay.
Right? So when I'm wrong or I lose less. When I make more. And that's how I generate profits over time.
I think discussing about that specific event, it was really interesting. So I slept pretty early that day. I think I slept around 12 to 1 when Russia haven't said anything. So I was thinking, hey, the labor market was pretty bad and then the stock market went green again. So I'm just like, okay, it's going to end green. The next morning, I wake up on Saturday, the whole market is red again.
Yeah.
So I think in this extremely tumultuous times, right, the whole market, you don't exactly know where it's going.
No, you got no idea. Yeah. You have got no idea. You can just guess. Yeah.
It can open red, it can open green, but then it closes anywhere at once.
Yeah.
So I think there was this very interesting LinkedIn post, I think on your community tab as well. You screenshotted a whole list of different thumbnails from other different creators, the bigger ones like Graham Stephan, Andre Jake, even I think Kelvin Learns Investing. So they were all giving like extremely horrific faces and saying that how the market is going to crash, China is going to go to dooms and stuff like that.
Yeah.
And then you call yourself an optimist or a blind bull.
Yeah.
So maybe you might want to expand on a little bit about why there's this huge wave of uncertainty and people are just calling for a market crashing, another 20% from here, it's another leg down. Why do you still have that confidence in terms of saying that, hey, the market's going to recover and you still remain bullish?
So first of all, these people who are always the prophets of doom, it's nothing new.
Right.
Every freaking year, you've got people saying the market's going to melt down, that the US dollar is going to become worthless. Every year they say the same shit.
Right.
Every year, right? And sure, there will be years the market will crash 50%.
Okay.
There will be years, right? When will it happen? No one knows until after the fact, right? But if you keep listening to all this for the last 20, 30 years, where every year someone tells you the market is going to collapse, what will have happened? The last 30 years, you would not have made any money.
Right.
Or worse, if you had shorted the market in the last 30 years, you would have lost a lot of money.
Right.
All right. But if you simply ignored all these people and just held on to good companies in the last 5, 10, 15, 20, 30 years, or even 50 years, you make millions. Right? And that's what I did. Just ignore them, right? So the question is, why am I always a bull? Now, depends on the time frame. Okay, so always look at short, medium, long term. Okay. So short term could be next week, next month, whatever, right? So short term, am I always bullish? Of course not. Right? In fact, if the market's on a downtrend, then of course short term I'm bearish.
Right.
Right? So I posted on my YouTube page, on my social media, after the market ran up 18%,
Right.
and hit the 200 moving average,
Right.
and then it had a rejection, I was bearish. I told my subscribers, I've turned bearish, I'm shorting the market.
Right.
But I was bearish for how long? Maybe 1 week. Right? So I switched from bull to bear on short-term time frames because you got to ride the trends, right? Now, medium term, you could also be a bull or bear, all right? And medium term, which means a year or two from now, I'm actually still very bullish.
Right.
Okay, so I expect the markets to be at all-time highs next year. Okay, now again, if you ask majority of people, they don't believe that. So majority of people, medium term, they're still very bearish. They think that this is the beginning of a bigger crash, bigger bear market. We're going down 40-50%, and of course, no one knows who's going to be right until at the end. But we all have to take a stand.
Right.
Right. So I am the minority that believes that we have made the lows of this market.
Okay.
Right? We won't go lower. We may test that low again,
Okay.
but more or less, I think the downside is quite limited, right? And I'm quite happy that there are a few people who agree with me.
Right.
Okay. And these are people I truly respect. I don't respect many people, but I respect these people because of their track record. Okay, I'll mention their names. All right. So when I realized that they were on the same page with me, I said, okay, even if I'm wrong,
They're wrong.
I don't mind because these guys are good, right? So if I'm wrong with them, fine, I'll live with that, right? So one of them is Larry Williams.
Okay.
Larry Williams, I don't know if you've heard of him.
I heard of his name before.
Yeah, so he started trading before we were born, before I was born, right? And he's known as a very famous futures trader, where he has won many futures trading competition, right? So that's one guy, Larry Williams. Second guy is actually Edward Yardeni.
The one I've never heard of him.
No.
No, I didn't.
Okay, so Edward Yardeni runs Yardeni Research. So a lot of the charts you see on CNBC, all that, they're actually from Yardeni Research. I have a lot of respect for these people is they don't have an agenda.
Okay.
I mean, they don't work for a bank or they don't work for an analyst. They're not analysts where they're pushing a certain agenda, right? They are purely neutral. So they don't get an advantage whether they're bullish or bearish. So Yardeni is purely based on the facts. All right. So Yardeni also believes that we are more or less bottom, right? Tom Lee is cute, but I'll be careful because Tom Lee is always a bull, right?
Yeah, right.
And Tom Lee is also bullish on Bitcoin, which I'm extremely bearish about. So although I think Tom Lee is really cute, but I wouldn't just follow Tom Lee, right? And the other guy is Sam Stovall.
Okay.
You heard of Sam Stovall?
No, I haven't.
So Sam Stovall, he works for S&P's, Standard & Poor's.
Right.
He's been around again before I was born, right? And he's the guy who actually came up with the sector rotation model.
Right.
So again, Sam Stovall is purely a numbers guy, and he is also in the camp that we've made the lows for the year. And of course, the fourth guy is Jeremy Siegel, who is the professor of finance at Wharton.
Yeah.
Right? Yeah.
Understand. So I think from the entire discussion, yeah, it's true. I think in terms of short-term trends, everybody's trying to play the technicals. But I think in the medium term, at least even in my own community, there are quite a lot of people that are still saying that, oh, we will have even lower lows, maybe moving into 2022 and 2023 as well.
Yeah.
So I guess we'll see how
right?
plays out.
So medium term, I'm bullish.
Right.
Now, long term, I'm always bullish.
Right.
I'm always bullish. Whether is it China or India, I'm always bullish because I believe that 10, 20 years from now, markets will always be higher.
Right.
Right? Why? Because corporate earnings will always be higher.
Correct.
Now, of course, there are some people say, but how about Japan?
Right.
Japan, the stock market went nowhere in 30 years.
Right.
Why does the US market always go up in the long run? Okay. First reason is because of inflation. So inflation increases at least nominal prices,
value,
right? Sales go up, prices go up, and all those things, right? Second is growth, right? Population growth, wage growth, and all that.
Right.
And of course, the third thing is the fact that what makes up the S&P 500 are not always the same 500 companies. Correct. They kick out the lousy ones, they put in the good ones.
Correct.
So because of that, the market always goes up. Right. So what happened to Japan? Japan, trouble is the last 30 years, they didn't have much inflation. It was a very deflationary environment.
Right.
That's the problem. Yeah. Second is Japan doesn't have the population growth because the population is declining and people are aging. Right? Do developed countries have that problem? They all do. But the difference is Japan doesn't have an active immigration policy.
Right.
all right? Whereas in the US, immigrants are coming in, Singapore, immigrants are coming in, so that drives the population and the wage growth forward.
So I think there are a few channels, at least on YouTube itself.
Yep.
There are quite a few of us that are bullish on Alibaba, Tencent. So I think myself included, you, Adam Khoo, and I think there's another guy called Larry. So he's also a China tech, quite a China tech bull, and he talks about Alibaba and Tencent as well. So in this case, I think we have pretty much been pounded by quite a lot of people online saying that, you guys don't know what you guys are talking about.
You're communists!
Exactly. And talking about how China is going to collapse, and there's a lot of property related videos that was released recently as well. So maybe just broad-based question to understanding your allocation, right? From what I understood, I think your portfolio allocation to China sector specifically was probably around in north of 20% previously.
Yeah.
And then now it has come down to around 8%, I think, based on your last few videos.
Yeah.
So maybe can you walk us through your thought process on what happened, and do you intend to add, and what's your strategy moving forward?
Okay, so actually I started investing in China back in 2018.
Right.
2018, 2019, right? So I got into Alibaba, Tencent at a relatively low price to get a Ping An insurance.
Right.
So even if the big drop, I'm actually still above water on Tencent, for example. Alibaba, I'm underwater, but Tencent above water because I got in very, very early. Now, when I first started building a position in China, in fact, I never exceeded 10% allocation.
Right.
Because my philosophy since the beginning was always, whether it's China or India, I treat them as so-called emerging markets.
Right.
So emerging markets, I never have more than 10% allocation, right?
Okay.
So it was always below 10. But initially when I bought them, what happened? Alibaba went up like crazy.
Right.
Tencent went up like crazy. Everything went up like crazy. So naturally from 10%, it grew to over 20%. So it was a natural organic growth to 20%.
Right.
All right. Then, so this was before the crackdown in 2020, so forth, right? So since then, from 20%, now my China allocation has gone down to 8% for two reasons. And now I've not sold any China stock. Okay, it went down because of the natural drop in the share price, so the allocation dropped. Plus, I've been adding like crazy to my US stocks.
Right.
So buying the US stocks, China went down, so now it's 8%, right?
Okay.
So the question would be, so why didn't you add to China stocks? Why did you only add to US stocks, right? So now, back in 2019, 2020, right? Now, when I invest, I'm always comparing, all right? Now, at that time, US stocks like Microsoft, Alphabet, great companies, but expensive.
Correct.
They were really expensive, right? Whereas China, Tencent, Alibaba, great stocks, but damn cheap. So at the time, I mean, if I were to invest $1, would I want to buy something that's really expensive or something that's really cheap? I buy the cheap one. So that was my rationale for investing in China at that time.
Right.
Okay. But I already knew the risk that they have a government that has more clout than the US government. They can really squeeze their industries, right? So I love to give this metaphor at the time. So imagine there's an American girl and there's a China girl. Okay, they are both beautiful, they're both attractive, okay? But the American girl, if I bring her on a date, she wants to eat in high-class restaurants, so I'll have to spend $200 on a date. You know. Whereas the China girl, she doesn't mind eating at, the hawker center, so I could bring her out for $50,
right?
So which one would I rather bring out? Okay, so at that time I thought, okay, the China girl, cheaper to bring on a date, right? But then she has got a father who's very fierce, right? And he could barge into the door when we were making out and slap me on the face, right? But given the fact she was so cheap to bring on a date, I would add her, right? So that was then, right? But since the US market has come down so much, and I think that there are some US stocks that are really dirt cheap right now. Like to me, I think Amazon is still dirt cheap, in my opinion. So now that American girl, okay, she doesn't cost $200 anymore, right? She now come down to maybe like $80 on a date. So now if I compare both, $80 American girl, $50 China girl, not much difference. And the China girl is a crazy dad. That one has no crazy dad, although that dad is becoming a bit more fierce, Jay Powell. So between the two, I rather add more to that American girl right now.
Understand.
Yeah. Actually, so it's all about comparisons, right?
Right.
Yeah.
Based on that example that was given, I think no racist undertone here. Don't get this comparison.
You woke people, don't lose your shit.
Yeah,
okay.
Yeah. So I think that's a very interesting anecdote, and a very good example in trying to draw the comparisons, because when I first met Adam the other time, he actually gave me the same example and I was laughing my ass off basically. But I think it really pretty much sums up in terms of understanding yourself, your risk exposure, and how you're gonna tackle, at least on a portfolio level, how you want to allocate to different places. And cheap can always get cheaper.
Yep.
And I know a lot of people trying to call the bottoms for maybe Chinese stocks, for US stocks, regardless of which market. I think it's pretty much impossible to guess any sort of bottom.
Yeah.
So,
I mean, like for example, Alibaba.
Right.
If you ask me, I think it's selling at half price or more, right? So can Alibaba double? Definitely. When? I don't know, but it will double. But I also believe that Amazon and Alphabet are also at half price,
right.
right? And they will also double. So if between Amazon, Alphabet doubling and Alibaba doubling, honestly, I would rather add more to the US ones because they don't have that overhang of that crazy father coming in and screwing up your date.
Right.
Although having said that, looking at the other way, you notice that now in the US, they want to tighten monetary policy, right? J-Power is like tightening monetary policy, right? So now it's like that father is saying, you know what, I don't want my daughter, she's partying too much, she's enjoying herself too much, I want to restrain her now.
Right.
Whereas in China, they're now stimulating the economy, they're cutting interest rates. So now that crazy Chinese father could be getting more lax.
Right.
And the American father could be getting more strict.
Okay.
Right. But in the long run, the American father doesn't have much teeth.
Okay.
You know, I don't know who is it who said that. Was it you on your video or what? But something I read where in America, they let companies innovate.
Right.
And they try to regulate, but they can't. Because the companies will run rings around the legislators.
Right.
Right. So it's a cowboy town, which is good for investors, right? In Europe, they over-regulate until no one wants to innovate.
Right.
Okay. When in China, they let them innovate, everyone's partying, and then they over-regulate.
Right.
So it's where you are in that cycle right now. So right now, China is in the area of that over-regulation.
Right.
Which will end eventually. It doesn't last forever.
Right.
Yeah.
I think that was I quoted that tweet from one of the Twitter.
Oh, it was you, okay.
Yeah,
so I stole it from your video.
Yeah, I quoted it from one of I didn't came up with it also, it was another creator that was on Twitter. Yeah, so I think after understanding the whole thought process and thank you for sharing with my audiences and understanding the whole market as well. Maybe just to kind of end off the concluding thoughts of this video, right? Is there anything that is keeping you up at night today? Whether is it about life, about politics, about the markets, etc. Just your own life?
Not really. I'm an optimist by nature.
Right.
So I'm the kind of person where I believe that everything works out in the end.
Right.
You know, everything works out in the end. I mean, even if touch wood, I get hit by a truck tomorrow,
right,
and I go to this wonderful place out there and enjoy myself with the angels or whatever you believe in, right? It's also works out in the end, right?
Right.
So I always say that I read somewhere, I can't remember again where, right? That this was a research done by some university that something like 85% of all our worries in life never happen. Okay? And out of the 15% of our worries that do happen, 90% of those things that actually happen, we end up being able to solve them better than we expected. And they always end up teaching us lessons that make us stronger and better in the end anyway.
Right.
So if you look at the actual problems that screw our life up, in a worse way, it's like maybe 3%.
It's that tail end risk, right?
It's that tail end risk, which you can never predict when it's going to happen and what it will be. Yeah, so why worry anyway? Right. You know, I mean, it doesn't make sense living a life of worry and concern, right?
Okay.
Because you can't control it anyway.
Yeah. Ken, thanks once again to Adam for tuning into my channel, and for all of you who are interested for getting him. He's essentially a legend in the YouTube space, so please help me smash the like button. So
Alright,
yeah,
pleasure.
Yeah, with that, I'll see you in the next video. More importantly, I will see you guys on the moon. Goodbye.